The stock market can seem like a scary place for the uninitiated. However, investing in the stock market is one of the best ways for young adults to build wealth over time. The sooner you start investing and developing a strategy, the better your chances at a financially secure future. Investing feels like an exclusive club with membership requirements that are not meant for you. It's natural to feel that way. After all, most people don't invest when they're young. But it doesn't have to be that way forever. You just need to know where to start. Keep watching for tips on how you can make that happen sooner than later. Perhaps you have read about some recent spikes in the market and are wondering what it means for your potential investments. Perhaps you know someone who was recently talking about buying stocks as part of their retirement plan. Or maybe you just think now is a good time to get started on investing, so that someday in the future, you can retire rich instead of old and broke. Follow these things you are going to invest in stock market. Step 1. Understand the stock market basics. The stock market is a collection of exchanges, where companies and governments sell shares of their stock. Those shares represent a portion of the company's future profits. If the company does well and its stock price goes up, the profits of the company go up. Profits are turned into a cash dividend that investors receive. In other words, if you buy stock in a company, you're part owner of that company and entitled to a share of its profits. A share is a piece of ownership in a company. When you buy a share of stock, you own a slice of that company's success. When the company does well, you make money, and when the company does poorly, you lose money. Step 2. Decide how much you can invest. Before you can invest in the stock market, you need to know how much you can invest. The stock market can be risky and unpredictable, so you don't want to put all of your money in stocks. Instead, you should diversify your investments so that you don't put all your eggs in one basket. The easiest way to do this is to put all of your savings in one type of investment. That way, you know exactly how much you have to invest. For example, if you decide to put all of your savings into stock market investment funds, you know exactly how much you have to invest. If you have debt, then you may have a smaller amount you can invest in the stock market. That's because you need to make sure you have enough money in a savings account to pay your bills if the stock market suddenly takes a dive and you lose money. Step 3. Determine your investment strategy. If you are new to investing, you may want to start off with a simple strategy like investing in an index fund. An index fund is a type of mutual fund that holds many different stocks. When you invest in an index fund, you are investing in the stock market as a whole. If you have more experience with investing, you may want to employ a more advanced strategy like picking individual stocks. When you invest in stocks, you are buying shares in individual companies. To determine an investment strategy, consider the amount of risk you are comfortable with. Since the stock market is volatile, you need to understand that you may lose money while investing. The more risk you are willing to take, the more you may potentially make, but you may also lose more if the market drops. Step 4. Finding the right investments for you. There are many different types of stocks and investment options to choose from. Once you've decided on a strategy and know how much you can invest, it's time to start looking for the right investments for you. One way to start is to consider how long you plan to keep the investment and how likely it is that you'll need the money soon. For example, if you want to invest in a stock fund but may need the money in the next 6 months, that may not be the best choice for you. Another thing to consider is your risk tolerance. Perhaps you have a long-term goal that you're trying to save for. Find an investment that meets your needs and that is a good fit for you. That way, when the market goes up and down, you don't get too rattled and stay the course. Step 5. Stay the course. Finally, no matter what happens with the market, stay the course. If you are investing for the long term, like for retirement, don't get discouraged if the market has a bad year or two. In the long term, you will be fine. There will be ups and downs, and there will be times when you want to pull your hair out in frustration. Just be patient and remember that the stock market is a long-term game. If you're investing for a shorter-term goal like saving up for a house, then you may want to consider taking out some money and reinvesting it when the market dips. Remember, though, that the stock market goes up and down and that there is no guarantee that it will go back up again. Be careful and don't take out more than you can afford to lose.